Hello everyone. All right, so today we're going to be doing something very different. In addition to all the chart stuff I'm doing, I'm going to go over this book, Trades About to Happen by David. And I know this material because I have first-hand experience with it. But I'm going to be going uh, over his book and what he means. So if you read this book and you don't understand it, um, because certain things are, need to be explained. You're going to now because I know this material. So anyway, so let's just start. So the first chapter here is really, 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 really important because not only is it the first chapter, but this is like step one. I mean, the first step in trading is finding trade location or levels. Right? Levels for where you can trade off of. So the idea is, can you trade off a particular level? And if so, where's the level? All right, so this comes before looking at a chart, 5-minute time frame, looking for change of behavior, looking for springs and upthrust. Those are all secondary and tertiary. The first thing is where to find trades. And that's why he opened up with this, because you got to mark up the chart. And that is the step to find the trade location. So first, mark up a chart. Second, look at the levels of support and resistance, and then start looking at behavior around there on lower time frames. So you'll say, finding the trades is like fishing. Fish can be caught in any part of the lake, but they tend to congregate in specific areas at different times of the year. And big trades can be hooked at any point in the chart, but they often appear around the edges of trading range. So the edges of trading ranges, when you have a rally, right, or a high, that creates an edge. When you have a low, that creates an edge. So over here, for example, you have up, down, up, and then it starts going down. The high here is part of a range, the high of a range. So this trend, it's high here, is part of a range. So this would be on a lower time frame, maybe like 5 or 15 minute. And on the higher time frame, the high of that 15-minute trend or 5-minute trend would establish the top boundary or resistance level of a range. Because even on a lower time frame, although it looks like it's trending, on a higher time frame it might just be in a range. So consider this the top of an hourly range and the bottom of an hourly range, and these waves are made up of 5-minute bars, and these are 5-minute waves. All right, so I'm trying to give that context of combining the higher time frame and lower time frame. In high time frame, it's a range. In lower time frame, it's a trend going from low to high and high to low and low to high. So you can understand that where the range is coming from and where the trend is coming from. Additionally, you might just look at a 5-minute chart and say, hey, this is a high, this is a low. That's fine as well. All right, and the point is you got to know the edges. So this is the range prior to the breakout, which happens here. So prior to the breakout, this high of the range and low of the range is marked. All right, now trading range do not have patterns. Price may twist, turn, and in a myriad of ways before it's resolved. So when you have a trading range, he said it doesn't have patterns, but we know that you have like flags and all of that going from the high to the low, like you have bearish formations and all of that. But it's better to focus on levels than it is to focus on the patterns. And the idea here is that within this range, all ranges are different. You don't have what's inside the range is like it's different from range to range to range to range. because what's inside of a range is various number of waves, various degrees of length, time and volume on each wave, various number of bars, etc. We are concerned with the dynamics of trading ranges rather than geometrical shape. That's why I said, forget about the shape, look at the dynamics of trading ranges. When the trading ranges evolve over months or years, they often expand their boundaries and contain smaller ranges. So ranges have ranges within them. What does he mean by that? With this dashed line here and this dashed line there, you have a resistance and support. But when we look inside of it, we see these dashed lines and this dashed line and this dashed line and this dashed line and this dashed line. So it's recursive in that the range has not only ranges in it, but entire trends. All right? So you have ranges composed of ranges. And those ranges, when you take a look at their immediate direction on a lower time frame, you'll see a trend. So you have ranges within ranges here. You can see it by the dashed lines. Support resistance, the big one, and then the support resistance, the little ones, here. The boundaries are repeatedly tested and or penetrated as the buyers and sellers struggle for dominance. So it's like, you get a test, a retest, maybe a spring, and you can really see if you look over any chart, you see, okay, test, retest, here, test, retest, break, test, break, test, break, test, break, test, attempting to take it out, finally break out. So you have tests and retests. And this is done at their boundaries, meaning you have a break and a test, or a rally and pull back to creek, rally to pull back to creek. Whenever the boundaries are breached, follow through or lack of follow through becomes the deciding factor. So I cannot explain to you how important this is. This is so important. You will not realize how important this is until you put like a zigzag indicator on your chart, and you will see constantly fake out, all over. There are more fake outs than there are breakouts. Many more fake outs than there are breakouts. You don't have to back test anything. Open any chart and you look. How many times it makes a higher high only to make a lower low and continue to trend? How many times it makes a slightly lower low only to continue to trend? Market trends are not higher high, higher low, higher high, higher low, higher low. It's not that simple. There are tons of fake outs and more fake outs than breakouts all the time. All right. So this is also the base evidence for this is the reason why breakout traders eventually fail, because they're at a disadvantage. In normal conditions, the breakout, buying on the breakout bar could be a fake out, but the problem is there are more fake outs than breakouts, so most of the time you're going to be wrong. And also, you can look for expansion of volume on the breakout. So what? It's going to reverse. If it doesn't have follow through, you can have more volume and a bigger bar in the opposite direction, taking you back within the range. So I see that all the time. Anyway, so where was I? When the boundaries are breached, follow through. This is the critical thing. So I'll explain what follow through is. Let's say you have a breakout green bar. All right? So you have a breakout, it has a green bar. After that, you should get another green bar. And that other green bar should make higher high, higher lows. If, on the other hand, you have a breakout and you have a red bar, and the red bar is going back within the range, there's a problem. You want to see a green bar breakout followed by more green bars, making higher high, higher lows. not a green bar breakout followed by a red bar breakout taking you back within the range. So that's after the breakout, whether you get a green bar making a higher high, a higher low, or a red bar, that will indicate whether you're having follow through or not. The deciding factor, very important, follow through. This other thing to say is that breakout, you cannot say there's a breakout without saying there's follow through. In my opinion, you cannot say there's a breakout without. Breakout is like only 50%. It's like a half a statement. It's only 50%. You have to say breakout, follow through, because the breakout by itself could be a fake out. And then once that happened, prices often retest these areas after the breakout. What happens? Prices test. So in the next few chapters, we'll examine characteristics of price volume at these various points. And we are dealing with trading ranges of all sizes, not only at tops or bottoms. The behavior described here occurs on all charts regardless of their time period. All right. The first step involves drawing the trading range. Drawing the trading range. First step. So ask yourself, as a Wyckoff trader, what's your first step? What are you doing? As a Wyckoff trader, what is the first step and what are you doing it? So for example, a lot of folks, their first step is anything but drawing the trading range. So especially on a higher time frame. So what they'll do, for example, is just put volume profile. Or what they'll do is just put market profile. Or what they'll do is just look at oscillator. Or what they'll do is look for, I don't know, something or the other. But what I'm trying to explain to you is the first step, as Weiss says, is drawing the trading range. Yes, you can add additional tools, whatever it is that you use, like profiles or order flow or whatever, with the order flow chart and looking for delta and imbalance and all of that. But the first step here, according to Weiss, is drawing the trading range. The rest of the steps that you use are next. Step 1 is the range. And I think step 2 should be the lines, like the channel, the trend channel. Right? So step 1 and 2 is the range and the channel. Right? So here you have a high. What you want to do is draw the line. Here you have a low, draw the line. All right? And when you go to a lower time frame, boom, boom. Right? All right. So now we're going to analyze this. So here, draw the fucking lines. That's the point. All right. And believe me, this is a big mistake that folks make, is not drawing the lines and just looking at a chart. And there's many reasons, because there's a lot of alternatives and a lot of noise, a lot of methodologies, and a lot of marketing. But I'm just showing you what this is, and this is like the 101, you know, drawing the support resistance. Anyway, look at the 6 trading ranges. By repeatedly framing the support resistance line, we see how trends consist of individual ranges and the turning points emerge from otherwise tangle of price movement. These turning points, springs, upthrusts, absorptions, and the test of breakout and breakdowns, serve as action signals. All right, so what he's saying is draw the lines, and when you draw the lines, then you will see the turning point levels. All right, so you're going to make sense out of the tangling of price movement after you draw the lines. after you draw the lines, you will see things. What things? What behaviors? Turning point behaviors. What are the turning point behaviors? One is the test of the breakout or breakdown. Once you have a test, and you might have a retest that's slightly a little bit higher, and that's your upthrust. And if it's a pullback, a bullish pullback, you may have a test and then a retest, which is slightly a little bit lower, which looks like an ABC pattern, right? Corrective pattern. That C in the ABC is your spring. All right? You can have a spring on a test of a breakout or breakdown, as well as on a range. This is a spring of that low. This is an upthrust of that high. So once you draw the lines, you'll see this. The first thing you should be looking for is for tests. Second, understand that tests can be retested, and when they're retested, they have a tendency to make springs and upthrusts. And your eyes will be ready, you'll be ready to see them because you drew the lines. And a lot of times when you have a market that goes to the line and starts hugging it, you will see, because you have a line, you will see hugging the line, prices hugging the line, and you'll see absorption. And all of these are action signals. So first is a test of the breakout breakdown, its retest, its springs and upthrusts, and absorption. But it all starts with the test of the breakdown. Notice how these are variants. Remember, test of the breakdown has a variation, which is the spring or the upthrust. And yes, spring or upthrust can also be at the high and the low of range, but they can also be on a test of breakout breakdown. All right? So what are we looking for? Very clear. Test of breakout breakdown and springs and upthrusts and absorption. So note these three things. Test of breakout breakdown, its retest, which typically can be a spring and upthrust, and then absorption. And these are your action signals. All right, now I'm not going to go into effort, reward, and all of that. All right, so we'll go over that later. But these are the action signals he's mentioned here. Okay, there he goes. So later chapter volume will be incorporated into understanding, but first we need to focus on the lines. Reading a chart without lines is like studying a map without boundaries. It's the subject of the next chapter and serves as my first step in my method for reading charts. So draw the lines. Draw the lines, step 1, so you can see the test of breakouts and breakdowns, which are action signals, as are springs and upthrusts, as is absorption. These are the turning points. All right, particularly the test of the breakout and breakdown, and its retest in the form of a spring and an upthrust. That's his main tool. Main quote-unquote setup. Setup is this. The turning point set up, where to look for it, is on the test of a breakout breakdown, spring, upthrust. Those are the key ones. And then yeah, you can have absorption as well. Right? Here is an example. How do I make this bigger? Here we go here. Yeah, there you go. Now you can see it bigger. All right. So we see this low. There's a spring of the low. We see the high. Right? We do this because there's lines drawn, and we see the spring of the low. We see the break of the high. we see the test. And again, if you draw a line here, it would be a break. Comes back down to test. It's actually a test right here that didn't go up, but it failed and came down to test this original breakout. So because we have the line drawn, we can see the breaks. Here's the absorption. This is a high, pulls back. Let's draw the line. Break. Goes up, down. Let's draw the line. What happened after the break? Test. I mean, you can see it's break and test and break. Break, test, test. Absorption, break, test. I guess this is a break. Test. Upthrust, meaning inability to break. Break down, back into the range. Break down, test. So basically, if you draw the lines, you see break, test, break, test, break, test, break, test, break, test. And if you see a retest, it'll be a spring. And the other thing you'll see around those lines is absorption. So break, test, spring, absorption, again and again and again. All right. Oh boy. Drawing lines. So much trading and technical analysis looks easy. Trends do require breakouts in order to persist. Very, very, very important. All right, trends, basically those higher high, higher lows, that diagram of higher high, higher lows is not showing you that between the higher high and if the prior low is a breakout. Between the low and the high in that diagram, in the trend diagram that makes higher highs, higher lows that everyone knows about, between the low and the high, you have breakouts, breakouts. So that's why trends do require breakouts and follow through in order to persist. Unfortunately, many fail. The penetration of trend line does nothing. What precedes the trend line reveals more, etc., etc. All right, so let's just start. We're going to start talking about this chart. All right. All right, so we see a great deal of movement. September 25th highs right here. All right, a resistance line is drawn across the high and the initial low on 10-2. So this is your high, this is your low. High, low, or rally, pullback. High, low. At two of these points, sellers attempted to control the stock and drive prices lower each time. However, the buyers checked the decline and prices recovered. It's important information. It tells us that buyers remain dominant. The support line brings the struggle between the buyers and sellers into focus. All right, I think he's talking about these points, 10-2 and 10-24. Sellers try to push, rejected. Again, rejected. And then he starts talking about here, saying, how come it's not rejecting anymore? Why is it grinding up like that? And it's because it's in strong hands. But the point here is drawing the lines. If you draw the lines, what are you going to see? You're going to see a high, a low, but what else are you going to see? What did he say you're going to see that I just went over? Even here, what did he say? Spring, breakout, pull back, test, tries to go, pull back to near the support level, break, test, up thrust, spring, attempts to retest the up thrust, another spring, right? Retest. So you can see what you basically have a breakout, tests, sometimes goes lower and does a deeper test, then it goes back, establishes a high, pull back here, establish the high and the low, up thrust, spring, retest up thrust, retest spring with a spring, and then finally absorbs whatever's here and does whatever it does. All right, so draw the lines and you'll see this. Where are the trading opportunities? Take a guess. The up thrust here is a trading opportunity. The spring here is a trading opportunity. This spring here is another trading opportunity because they represent turning points. This break here with a pullback, if you draw the line here, is a possible trading opportunity. So break here, pull back to test across this high, trading opportunity. This is a trading opportunity. Its retest is a trading opportunity. It's another retest is a trading opportunity. This is a little bit higher up, but if you consider it a test, it is a trading opportunity. Here, the counter trend trades, or it's the up thrust is a trading opportunity. The retest should be, it's all right, but this may be because it's up thrust. All right, but it's counter. So the idea is once you draw the lines, you have the break and test, the retest with the spring, trading opportunities. And that's about it. Everything really has to do with drawing the lines and seeing a break and a test and a break and a test and a break and a test. Sometimes those tests are deeper than the prior test, creating a spring, which is a trading opportunity. And vice versa for the up thrust, creating a trading opportunity. All right, I'm gonna stop right here. Good luck. If you want to learn, just follow along. I won't go into all the details of every chapter because I'll go crazy. But I don't want to go into like how to read a bar, stuff like that. All right, so take care. Bye.